Welcome, everybody, to another episode of the Smart Money Circle. My guest today is Stephen Hartel. He works at Trilogy and helps oversee $3 billion in assets. Stephen's got a wealth of knowledge, and I'm very much looking forward to the show. So without further ado, let's jump right into it. Welcome, Stephen.
Thanks, Adam. Happy to be here.
So, Steve, can you tell us a little about your story and how you got involved in the business?
Sure. Generically, I've been a finance guy my whole life, but I started out as a corporate financial analyst and did that for 20 plus years and kind of got burned out on corporate life and was trying to figure out what my next great adventure should be. And I did some soul searching and really decided that when I looked back on my 20 years in corporate life, the only times that I had truly been happy was when I was working in small groups and where I was directly helping somebody. So it just made natural sense for me to jump the fence to the personal side of finance, where I could help people one by one. You know, I sometimes say I'm making the world rich one person at a time.
I love that, by the way.
Just for my compliance friends, by rich, I don't mean to be promising oodles and oodles of dollars. I mean the more self-fulfilled and goal realization definition of the word rich.
Intellectually rich. How about that?
Yeah, I like that.
That's what I strive to do with my audience.
Perfect.
So that's a great story as far as getting involved. And then you moved into the business. Now you work with individuals. Can you tell us a little about your investment strategy, please?
Sure. I have kind of a couple of guidelines around that. The first one is that I believe it's important for you to have a strategy for each bucket of money that has a unique purpose. So I don't just look at someone's global portfolio of every dollar they have and treat it as a single thing, because I believe that your attitude and your risk tolerance and your time horizon and just literally the way you think about your retirement money should be different than the way you think about your college saving for your kids' money, or your saving up for a down payment on a house money, or your all the things I want to do between now and when I retire money. I think each of those needs to be treated as a separate bucket and invested appropriately.
So that's a great point. So basically you break down the overall portfolio and look at the assets, and then you define the objective for each bucket, and then you develop an investment strategy that meets that objective. Is that correct?
Correct.
All right, that's a great way. And then this way you don't have to worry about being aggressive in an account that should be conservative, or vice versa, or moderate, or whatever the case may be.
Yep. I think each one will have an appropriate level of risk for whatever its purpose is.
Okay, good. I'd like to get to risk in a second. Before we go there, I know you do planning as well, and can you speak a little about how, or walk the audience through the process of what an appropriate way is for people to view their wealth and plan for it?
Sure. I hate, the phrase goal driven has almost become cliche now, but I really believe it, and I think it's true. I think you need to focus on what is the goal and what are those dollars going to be used for, and think about it that way. And so when I do financial planning with a client, we spend a tremendous amount of time picking apart what is it that they want out of life. It's not enough to just tell me you want to save $50,000 for your kid to go to college, because I'm going to ask why. And what does that mean to you? And how important is that? And it's not enough for you to say, well, I want to retire comfortably. I need to know, what does that really mean? And we'll dig into it a lot. And I ask many questions that people have never heard come out of the mouth of a finance person before. And it really spawns some great discussions. And I think it's one of the things that leads to the loyalty I do see with my clients, is they know that I've really dug in and I get what their why is, and that's really what we're working towards.
Oh, that's fantastic. Can you give us an example of one of those questions, or how you approach things differently than the average Joe, so to speak?
Well, sure. So, I've had people come in and say, I can't retire until I have saved $1 million. So I need you to help me save $1 million.
Right.
Or I've had somebody who will come in and say, well, I guess college is around 50,000 a year and I have one kid. And so 4 years is 200 grand. I guess I need to save up 200 grand for college.
Right.
And, I think your average advisor would just be thrilled with answers like that and would say, well, great, here's the new account form. Let's get you going. And how much money can you dump in each month?
Right.
But what I have found historically is that when you do that, people get bored and they give up and they lose their motivation because it doesn't mean anything to them.
Right.
So I will dig in. Well, why do you want your kid to go to college, and what kind of college, and did you go to college? What was your college experience, and why do you want it to be different or the same for your kids? And have you thought about whether you want the kid to have any skin in the game or not? And, do you care where your kid goes to college? And
Right.
so we'll go down all those rabbit holes until we eventually understand what's really making them tick. And then we can go back and look at the dollar figures.
So by skin in the game, Steve, do you mean the kid have financial skin in the game?
Yeah.
Yeah. And then it'll help.
There's no right or wrong answer to that. There are plenty of people who seem to think that it's a God-given right that your parents pay for college for you.
Yeah.
And I have nothing opposed to that if you're a parent and you want to do that. But I want you to have thought about all the different angles of, do you think it might be more meaningful if the kid gets a part-time job and contributes something to the process, even if it's just her own beer and pizza money or something,
Exactly. And then this way it builds character too and all that other fun stuff.
You got it.
Yeah. So as far as the why, when you dig down with your investment strategy and you find out the person's why, how does that actually impact the actual investment decisions you make or recommendations you make with respect to allocating the funds or the portfolio?
So it has more to do with everybody's wish list is bigger than their pocketbook.
Right.
And so the way I use the why is to help prioritize those things, because if a client only has X dollars every month that they can throw at all of their goals, in most cases, we run out of X before we run out of goals.
Right.
And so we have to really have some conversations about, if you do this, then you can't do that. And which of those is really more important to you? And if we've dug into the why, then being able to answer which one is more or less important suddenly becomes way easier for the client.
Yeah, that's very smart. It's almost like the concept in economics of scarce resources, right?
Yes.
So
yes,
if you have
at my firm, we often say there's only 100 pennies in a dollar.
I love that. That's great.
And the average client comes in with, $3 or $4 worth of wishes.
Right.
And if there's only 100 pennies, we've got to allocate them somewhere. And whether you realize it or not, every one of those pennies is connected to every other one of the pennies. And, it's like a balloon. If you poke it in one place, it sticks out somewhere else.
Right. So now that we understand the why and how critically important that is, when you actually go make the investments, are you more fundamental in nature, more technical? And how do you actually allocate to the portfolio once you understand the person's why?
Got it. So I'm a big believer that emotions are the single greatest evil in the investment world. So my firm uses set portfolios that are all rules-based.
Okay.
And what we've tried to do, I've been with this particular firm for 10 years. And when I first joined this firm, we were very big into using mutual funds.
Okay.
We believed that at that time, that was the best way to get professional management and good diversification and, not too much cost.
Right.
And over the last 10 years, our philosophy has changed, and I think the stock market has changed. And so we tend to use much lower cost instruments. So most of our portfolios are constructed with exchange traded funds,
Okay.
ETFs, where the management fee is virtually non-existent.
Right.
And so you still get the great diversification, but what you have is now this basket where nobody's driving the boat.
Right.
So there's no intelligence.
Right.
And so we finally got to the point where we are large enough that we can provide that intelligence across all of our portfolios ourselves and do it for a much lower cost than if we hired a management team for each separate portfolio. And so we have rules and a market committee that determines which of those undriven boats should you be in at any given time and in what proportions. And generally speaking, we're not high volume traders. We tend to pick a flavor or a particular strategy that a given portfolio follows and stick with that. And we have some that are more strategic in nature and some that are more tactical in nature, some that can bob and weave a little bit more. But we're not into real market timing or anything like that. We tend to have some tried and true, very boring, plain vanilla, not sexy, not the kind of thing you can brag to your buddy at the gym about how cool your portfolio is. Because the data, the research shows that the simpler portfolios outperform over the long run.
No, that's a great point. So it's not so much it's plain vanilla, but it works. I mean, that's your point. It's not sexy from a owning the latest growth stock or whatever, the latest flavor du jour or stock du jour. It's more along the lines of it's stable and it works. So don't mess with it.
Correct.
Yep.
Exactly.
That's a great point. And then the intelligence, the ETF or the mutual fund is just a strategy, but the intelligence is to know how to build a portfolio with the right ETFs at lower cost to make sure that you get the results you want, at risk-adjusted results. Understood. So the next question, we earlier spoke briefly about risk. We said come back to it. Let's go back to that topic because I know risk management is one of the most important topics out there. How do you manage risk, and what mistakes do you see people make with respect to risk management?
Oh boy. I'll start with the mistakes part first because that's easier.
Sure.
I think the single biggest mistake people make is they have absolutely no idea of how much risk their portfolio is taking on. I can't tell you how many people come in and say, well, I own an S&P 500 index fund, so I'm not very risky.
Right.
Or I own an S&P 500 index fund, and so I'm totally diversified.
So let's educate the audience for a second there before we move to the next point, because a lot of, like you said, so many people believe that. Can you just help bust that myth or shed some light on that faulty conclusion with that statement?
Sure. Absolutely. So the first part is that an S&P 500 index fund is 100% invested in equities, which is not middle of the road. That's way up there. That's, on a 0 to 100 risk scale, that's like up in the 80s.
Okay.
And the second piece is that the S&P 500 is the 500 largest companies. And so it is a very skewed segment of the economy. It is simply really big companies.
Right.
And it totally excludes any companies that are small or medium or growth oriented or technology or niche market. There's no timber or mineral resources or Chinese left-handed smoke shifter companies in there.
Right.
It's just giant U.S. companies,
right,
which is only a segment of the market. It's not diversified.
So the people think they're being diversified, but they're actually, in reality, they're not.
Correct.
And they also think they're mitigating their risk, but in reality, they're not.
Correct.
Okay. And then if you want to keep going with the mistakes, I just jumped in because I wanted to clarify that point.
Yeah, no problem. So I think the average person, when I first will ask them just point blank on a scale, our firm uses a 1 to 6 scale.
Okay.
Simply because it's easy. People can kind of get their hands on that. And I'll ask somebody, how risky do you think you are?
Right.
And then I will run them through the relatively standard, everybody has their risk tolerance questionnaire where they ask a bunch of questions.
Right.
And the important part of that questionnaire, I mean, everybody knows that when the market's going up, you're going to feel good.
Right.
So the real question is, when the market goes down, how freaked out do you get?
Right.
And, so our questionnaire has about 6 questions that ask that in different ways.
Okay.
And gets people to look at it differently. And invariably, I would say 80% of people score 2 or 3 notches lower than what they thought they were.
Meaning they're more risky or they're less risky? They're more conservative or they're more aggressive? Or does that mean 2 notches lower?
When you ask them how much risk are they willing to take, they'll say, "Oh, I'm a 5 or a 6. I like lots of risk."
Okay.
But then when you pin them down with specific questions, like one of our questions says, in any one given calendar year, what percentage loss are you willing to withstand before you're picking up the phone and calling me in a panic saying, "Oh my God, quick sell, go to cash before we lose any more"?
Right.
And the answers to all of those questions don't end up correlating to somebody who's a 5 or a 6. They correlate to somebody who really doesn't have as much of a risk tolerance as they thought they did.
So it's like a 3 or a 4, 2 notches below.
Yes.
Got it. Okay, that makes sense.
Exactly.
So there's almost there in psychology, there's cognitive biases, and one of them that I like to talk about all the time that I see with investors is the personal blind spot bias. Meaning it's much easier to point the finger and say someone's doing that than for you to see your own flaws and say you're doing it. Like ask 100 newlyweds how many think they're going to get divorced. Nobody raised their hand. Meanwhile, the statistics show us half the group is going to get divorced. So basically, they have a flawed view on their own appetite for risk, is what you're telling me. And then when
it's an optimism bias.
Optimism bias. Okay, got it. And then when things go bad, that's when they actually panic and their actions differ from what their perception of their actions would be when the bullets are flying and the market's down.
Yep.
Got it.
Yep. So you asked how we manage risk.
Yes.
Every one of our portfolios is calibrated and measured for its volatility, which we use as a surrogate for risk, right? How much does it go up or down?
Okay.
I will sometimes use the metaphor of an amusement park, right? Is this portfolio a merry-go-round ride, or is it a roller coaster, or is it something in the middle?
Got it.
And so once we know what kind of ride you're comfortable with for each particular bucket, because again, if you're 35 years old, you should be willing to ride the roller coaster on your retirement bucket, but maybe not on your house down payment bucket.
Right.
So once we know that, then we're going to keep you in a portfolio that is adjusted. When I talked about that intelligence that we provide, we aren't necessarily doing everything we can to squeeze the last 0.1% of rate of return out of each of our portfolios. We are way more concerned with keeping the level of volatility constant because we do not have a crystal ball and we have no idea what the market's going to do tomorrow. And so we need it to be properly positioned today so that when we get surprised tomorrow, we're not actually surprised.
So it sounds
we're in the right spot.
Yeah, it sounds like you almost, the Fed stress tests banks. It's almost like you guys stress test your own portfolios in advance.
That's a great way to think of it. I like it. But we have, some of our portfolios that are more tactical in nature. Sometimes we're making a move because our committee says, gee, based on the current economic environment and the economic crisis that European country X is suffering, it might be smart for us to slightly underweight our European holdings for the next 6 to 12 months.
Right.
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 So just sort of minor over and underweighting, which I think is extremely common in the investment management world. But it is far more common for us to be switching out one ETF for another to keep the volatility level where we want it. So, there's probably, using my other example of European equities, there's probably a dozen ETFs that focus on European equities. And so our decision about which one to be in when is driven by volatility rather than do we think Europe is the right place to be or not.
So without giving
if that
away,
makes sense. I mean, the allocation, like should your portfolio be 10% or 12% European weighted? That's driven based on our view of the economy.
Okay.
But which specific ETF is based on the risk level.
Understood. How aggressive it is and all that fun stuff.
Yes.
Yeah.
We want to be able to say that if you fill out the risk survey and you're a risk level 4, that no matter what kind of weather comes up in the stock market, you're going to get a level 4 ride because that's what you signed up for and that's what you hired us to do.
So you say you adjust for volatility. What does that mean in layman terms? I mean, when the market goes down, is it upside volatility and downside volatility, or is it only downside volatility that you adjust for?
It's both.
It's both. So if the volatility picks up on the portfolio, just to clarify for the audience, downside volatility means the market goes down big. Upside volatility is the market goes up big. So for you to smooth out the ride, you don't want to see big swings in volatility or in the P&L of the portfolio. So whenever you start seeing big swings in the market up or down, you'll adjust accordingly. Is that correct?
Yes, and we might adjust up or down, right? I mean, if
Right.
you're in a level 6 portfolio, which is supposed to be a roller coaster ride, and we see the market trend, the volatility increasing in an upward direction, we're going to switch out to the ETF that we think will give you the biggest upswing.
Right.
So it works both ways.
Well, that's what, hence the question, right? So yeah, there's upside volatility and there's downside. Lots of guys talk about volatility downside only. That's why I just wanted to clarify for the audience to make sure I understood what you're saying properly.
Yes.
Got it. No, that's great. So as far as risk management, you basically, if I just to summarize this section here, and then we can move on to the next topic, is the way that you look at risk is beforehand, before you get invested, you understand the why, you understand the risk tolerance of the individual or of the account holders, and then you go and develop a strategy that works for said goal or for said, objective with their risk in mind. So you stress test the portfolio and the client's reaction to upside and downside volatility in advance before it happens. So this way, when it actually happens, there's no one taken by surprise. It's all planned out for.
Exactly.
Okay. That's a great approach. And then, sorry, go ahead.
Well, I have heard other wealth advisors or financial planners kind of jokingly say that one of their biggest jobs is to keep their clients from doing something stupid in the stock market.
Mm-hmm.
And I think what our approach does is it sets the expectation ahead of time so that if you signed up for a level 3 ride, you're going to get a level 3 ride, and therefore you're not surprised when you get a level 3 ride, and therefore you never have the urge to do anything stupid because you got exactly what you signed up for.
Right. And everybody's on the same page. By stupid, you mean emotional, right? Making an emotional decision, not rational.
Yes.
So yeah, that's you're speaking, preaching to the choir, so to speak. I have a book coming out called Psychological Analysis, which is in addition to fundamental and technical analysis. And the whole concept is that people make emotional, not rational decisions with their money. So the idea is to fix that, and hence the whole topic of the book. So I'm very, very much aware of what you're saying and familiar with it, and I've seen it in my own world. So it makes perfect sense. Perfect. Well, Steve, that's all the time we have for this segment. For the audience, stay tuned. We're going to have another segment coming up, or another show coming up, where Steve's going to give us some timeless lessons, talk about some of the best advice he's ever received, and a whole lot more. Once again, I want to thank you, Steve, very much for being here. Steve Hartel with Trilogy with $3 billion in assets under management. Before we go, Steve, what is the best way for people to get a hold of you or get in touch with you?
Well, so our company's website is Trilogy FS, as in financial services.com. And there's a page right on the at the top of the page of Find an Advisor, and I have a whole page on the company's website, and that also gives listeners a chance to sort of see what our firm is about and all the different kinds of planning that we do. You can find me as well on LinkedIn or Facebook or any of the traditional social media platforms, or telephone.
Perfect. And what is the number to reach you?
So my phone number is 303-300-3323. So lots of threes in there. And my direct extension is 5221.
Well, thank you very much, Steve. That's fantastic. And we'll be right back for another episode. Thank you all.